Hello everyone. The fifth video in this series is about savings and budget. There are 6 types of savings options: regular savings, high-yield savings accounts, money market accounts, certificates of deposit or fixed deposit, cash management, and specialty savings account. In specialty savings accounts, there are 2 types of saving accounts: 529 college saving accounts and health saving accounts. Regular and high-yield savings. A regular savings account is a place to store money whilst earning interest upon the amount of money stored. It's easy to open and has a higher rate of interest compared to checking accounts. However, compared to the other saving accounts options, it has the lowest interest rate. If withdrawals are made from the account over a certain limit, then fees are applied. A high-yield savings account is a type of savings account. Typically, it pays 20 to 25 times the national average of a standard saving account. Compared to a regular savings account, a smaller number of withdrawals are permitted, and different banks have different rules and fees in terms of the number of withdrawals. The interest rates are based on the average balance in the account in a specific month. Money market accounts. Money market accounts are offered by banks and credit unions. They have a higher interest rate and have federal insurance protections. They also offer check writing and debit card privileges. However, they require customers to have a minimum balance in the account, and fees must be paid if the amount isn't maintained. There are also a limited number of transactions that can be made through a money market account. Fixed accounts. Fixed accounts are a type of savings account that holds a fixed amount of money for a fixed period of time for a fixed rate of interest. There are 4 key items in FD: interest rate, term, institution, and principal. The interest rate is the rate at which interest is being added to the amount of money during the fixed period of time. The term is how long the money is in the savings account. The institution refers to the bank or credit union where the account was opened. The principal is the original amount of money that was stored in the savings account. The Federal Reserve Board's Open Market Committee determines every 6 to 8 weeks if the federal funds rate should be raised, lowered, or left alone. If the rate is lowered, then the fixed account rate is also lowered. Cash management. Cash management is the process of managing cash inflows and outflows. It is important to maintain cash balance while also earning a return on idle cash. Two ratios can be used to analyze liquidity and solvency: current ratios and quick ratio. The current ratio is calculated by dividing current assets by current liabilities. The quick ratio is calculated by dividing cash equivalents plus marketable securities plus accounts receivable by current liabilities. Specialty Savings Account 529 College Savings Account. The 529 College Savings Account is a tax-advantaged savings plan designed to help pay for education. The savings grow tax-deferred and withdrawals are tax-free if used for the qualified education expenses. They are run by states and the rules differ by plan. Since they are run by states, the tax benefits provided differ according to the state. If withdrawals are made for non-education purposes, there is a 10% penalty and the customer has to pay taxes. Anyone can open 529 accounts, however, they are usually funded by parents or grandparents. There are 2 types of 529 plans: savings plan and prepaid tuition plan. The savings plan is the more common type of account used. It's invested in mutual funds and withdrawals can be used for college and kindergarten to grade 12 expenses. The prepaid tuition plan is offered by a limited number of states and has restrictions on which colleges the plan can be used for. However, they allow the customer to lock in tuition at the current rates for attending college in the future. Specialty Savings Account, Health Savings Account. Health Savings Account is a tax-advantaged account that helps people save money for medical expenses that are not reimbursed by their highly deductible health plans. The account is owned by the employee but can be funded by an employee or the employer. contributions are vested and unused balances at the end of the year can be carried forward. The max contribution in 2020 is $3,650 for individual accounts and $7,300 for family accounts. Unlike a flexible savings account, which can also be used for medical expenses, the difference is that the unused funds can be used in the next year and the limit for the FSA is capped at $2,750. A budget is a plan to decide what to do with every dollar earned. There are 3 ways to budget: zero-based budgeting, envelope system, and the 50-30-20 rule. Zero-based budgeting encourages the total spending of income on expenses, savings, and debt payments. The envelope system involves physically portioning out income to different categories. The 50-30-20 rule can be followed to divide how to spend the money earned. After tax, 50% of the income needs to go towards needs, 30% can go towards wants, and 20% can go towards savings. So if your monthly income is $3,000, then $1,500 should go towards needs, $900 should go towards wants, and $600 should go towards savings. How to budget. Number 1. Gather all the paperwork and calculate take-home pay. Take-home pay is the amount of income earned after taxes. Number 2. Create a list of monthly expenses. Number 3. Determine fixed and variable expenses. And number 4. Make adjustments to expenses to stay within the income earned. Thank you for watching, and I hope this has been an informative video. In the description box below, there is a link for a Quizlet which can help test you on savings and budgeting. Comment down below if you have any suggestions or questions, and click the like and subscribe button. See you next time.